while we're busy.
Okay, no, perfect, no, perfect. So, have you been? What is this thing saying? Oh, sorry, man. Uh, sorry about that mix-up.
Now it's
So
cool.
yeah. I hope you've been back testing that movement, that strategy, man, that I was talking about. So did you check the how it moved on Thursday?
The Thursday one, I didn't do the Thursday one, but I did
Oh, yeah.
do. But I did continue on Friday, and then there was some guys who wanted to do maybe Sunday, yesterday as well. But I checked the one on Friday.
Oh, the one on Friday. Yeah, I was not on the markets on Friday. Yeah, I was. Yeah, yeah.
Yeah, no, it's cool. I set to just the time frame that we have.
Oh, oh. Okay. Can you see the screen now?
Yeah, I can see the screen.
Okay, so like yeah, on Thursday, if you remember when we were setting up for this, you remember that the market opened on a Thursday. It was 8:30 London time. So remember as it opened,
Yeah.
uh, it basically the open was the same as the low. So basically the open and the low were the same. Was the same price ratio, and
Yes.
then it went to go create the high as well. It went to go create the high, and then once it created the high, you can see that it started shifting off because we had the meeting ended around about 11, which is around this interval here that we had. So it still went to go create another high after our meeting was concluded. And
Yeah.
you see that after it created the high, the price started shifting away from where the high was, which was this order block. So it basically validated that order. So it coming down was just it validating that level, that high. You see that? So after
Yeah.
then the price went up, and then you can see that the New York Open was actually this here, this candle. So as soon as it opened, this was the high. It took out the high immediately. So the London high was the same as the New York Open. You see that? So it had already taken out.
Okay.
They had already taken out that liquidity, which was placed there on that level. So after that, you can see it just hit a quick reaction, and then it started coming to come take out our low. See, so uh, it's just that on this day, we had positions open, but it was so volatile that we actually ended up closing at this level here after this candle. This is where we ended up closing, but
Yeah.
it did go. It's just that the market was just too volatile for our liking, and then we closed it here. So even if you can go on my Instagram, we we went live basically on Instagram during this release, so you'll be able to see what was going on basically step by step. You know, so if you wanna check that out, you can just go on my Instagram. It should be somewhere under lives or rail or something. I don't know, somewhere there.
All right.
Yeah, so you can check it out, and then you'll see where we have placed our entries. So as you can see, it did follow the system. It came down, and then it took out the low, and then it continued selling down. And then you can see that the market closed. Yeah, the market closed roughly here, and yeah, it was silence from then. So once we already saw this is a double top, you see, it's a double top move. We know that it's clear textbook. So as you can see, there was, if you can look at this rough this rough drawing that I have here, it basically explains that setup. As you can see, it usually is open, The London Open, yeah. So I was doing this with you, if I'm not mistaken, right?
Yeah.
Yeah, it literally followed the same pattern that we were talking about on that. As you can see, the low is just that on that one, like I said, in instance, the low can also be the same as the open, or the high can also be the same as the open. It just depends. So in this in case, it was just the low and the open was the same. As you can see, it created a gap. After it created a gap, it will start to shade. See, so the moment it moves, that's it verifying that high. That okay, it's made that high. After it's made that high, around about soon as New York starts, it will start to go take out that high. Or if it closes in the open, it's just gonna come shading down. CSC. So then it took out that high, and then that's the movement that we see, that connection. See, same is the same thing. If
All
I
right.
were to,
So when we're selling, yeah, in this particular example on when the high is taken out twice, it's still the same profit, right? It's not like it's not like it's gonna be like a situation where the the change in trend is gonna, like, do you get what I'm saying? If it like the way it did right now with on this example here.
yes.
Uh,
Well, the only thing that might happen is just inflation, which is just inflation above the level. But then, yeah, it's surely to go down once it sets up the proper formation. See,
and then the order block below that, just below that, that's what you put up, right?
which one? This order block.
Yeah.
Yeah, this one was just to show like where it started expanding on the up, because we have to have a neck. You see, so this is what I
Yeah.
like to call a neck. So that's the neck basically, and then it turns around just to go collect more orders, or that's its turning point to go take out the high on that level. You see,
Uh,
yeah. So whenever it's on this area, it's a proper risk area for you to take, because now it's already taken out the liquidity and there's no more liquidity on the upside. You know, the only thing that can stand in the way is just like inflation. You see, and you will just see that with like the continuing momentum of the buy.
yeah.
Maybe it just wants to compound the current low, or compound the current high, and then it will just continue until it comes to grab it after a day or two. You see. But for the
Um,
textbook wise, this is a textbook setup, especially on entities like your Nasdaq. See that?
oh, yeah. No, so yeah.
Yeah. So you should be memorizing this, basically this textbook setup when you're starting to deal with these indices. See.
This is also going to be something you come across with the pairs, right?
Yes,
And
yes,
in
yes.
general,
Yeah. This is something you're gonna come with in general when you're dealing with, yeah, with basically everything. But now this since we're putting like time frame on it, it's much clearer for you to see. You see, unlike synthetics, well, you can't really put a time zone on it unless you're just looking for when it starts to peak, like what's the peak time, which is usually like 2 a.m., which is the synthetics peak time, where like there's a lot of liquidity being brought in. But other than that, on most of your US pairs, whenever it's like a New York time session and you see this setup, you should know that, yeah, it's prime time. You know what I'm saying?
oh, yeah. So then now from after you pass 4:30, the next time frame is 8 again, right? Or is it at 3? I mean, at 3 a.m. Or is it somewhere before 3 a.m.?
It's like 1 a.m. 1 a.m. once
1
once they
a.m.
start.
Oh, okay.
yeah, they close at like 12 for an hour, open at 1. So it's 1 a.m. and then it's basically the Asians.
At 1 a.m. All right, cool.
Yeah, yeah. So yeah, that's just how it basically runs. You see, so
Yeah.
we'll just
I know it's quite walkable at the moment.
okay, yeah, so we're just gonna dive into, let's see what happened on Friday, because I actually haven't went to what happened on Friday. Okay, so it seems like a lot happened on, well, not actually a lot happened on Friday, but this is starting from the AMs and then going all the way to, so this is the section that we don't even look at as much. If you know, if that is the Asian right there. And then we have, okay, just give me a, just give me 1 minute. Just give me 1 minute.
All right.
So yeah, as I was saying, so yeah, let's get into our deduction. We know that uh, okay, we've placed basically our time boundaries have been placed properly. And then this is the open. Let's just mark it. And then open. Then we saw that it went to create a high. So we're marking our London high. And then you see that there's our low. Our low is right there.
Okay. Yeah.
So yeah, the London has basically created all of the confluence that we need. We have the open, we have the high, we have the low. So after it opened up, so you can basically see it's like a reverse. It's like a reverse of what we had
Yeah.
of that setup we had. So once it came down and created our low. So the biggest gap was in between the open and the low. And then from there it went up. Basically the market opened in the middle and then it opened, it pinned, and it just missed the high by a few pips. You see that it
Yeah.
missed the high by a few pips. So in this instance, it did not take out the high. You see that it did not take out the high. So once it did not take out the high, it came down and it took out the low. You see that once it took out the low, this would have been our entry. Yeah. Because now it has taken out
Yeah.
the low. So this would have been our
Yeah. So
entry
now.
to, to come and take out this high. You see that textbook
Yeah.
wise, that would have been our entry. You
Yeah.
see, yeah. So would have took the buy as soon as it takes out the low, we'll take the buy, and we would have exited it around here because reversal patterns. As you can see, it's clipping reversal patterns. So would have,
Yeah.
yeah, that would be, we would have jumped out as well because we're seeing these. But like, yeah, this would have been a textbook entry. So it's just that in this point, it was not allowing for the market to go take out the high. So maybe it was not enough orders, no enough liquidity for it to get up to there. So it would have also reversed and just close our entries. You see that. So since on the instance, since we had this high, I bet you that high was taken out today from today's market. So let's see that. So we still have that high. This low was taken out. So we're just gonna leave this and just keep that low there so we know what's happening. So this was today's market. And then this was Asian. So we don't look at Asian actually. We don't focus on Asian. And then we step into our London. So our low is the same as our high. See that? No, I mean our low,
Yes,
is the same as our open. I'm sorry about that. Our
the
low is the
open,
same
yeah,
as
yeah.
our open. So we can
Yes.
see that after then it basically had an expansion going to the upside, and then it came back, retraced, it pinned a few, and then once it pinned a few, um,
You struck in the New York time.
yeah, once the New York time came, this was the high. So it was basically like a compounded high, if you would say. So it came out and it took out
Yeah.
Friday's high, which was left over from last week, took out Friday's high, and then it just kept going. So at this point, it is compounding this low. It is compounding this current low here as the market did not react to take it. So it can still react and come back to take this low. Just that right now it's working on an inflation. See that it's just being inflated right
Yeah.
now. So it's just the inflation is also due to this compound as well. Today's and Friday's liquidity. So at this point, it's still New York session, by the way. So there's still liquidity that can be used and still have more liquidity to act on it. So the closest order block is at this level here, and it's approaching this level. So at this level, we'll be getting ready to see if there's any reaction into 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 getting the sell going. So yeah, at this point, as you can see, it's already starting to react. The momentum is getting lost from this action, and this action starting to move sideways. So it's actually a few pips away, if you can see it. So we might actually get reaction probably in the next few candles. So we'll just have to, let's just monitor it for now. So we might actually just get a reaction. So basically, so if we're following the textbook, we are getting ready for entry mode. So we
Yeah.
just give it, we just give it a few, and then we'll observe how the few candles that come in. So just besides from us back testing that, we have to get into your jargon as well, into your trading jargon. So when people say certain things, you'll be able to, to understand. So the most that we like to use CMP, if you've seen that, which stands for current market price. So when we're like sell USD Chief at CMP, we're basically meaning that you must sell it right now, as soon as you get the message. And if you're 5 minutes late, hey, it might be a problem. So then we have the OT, which is break of trend. So that's when we are looking for something to break a trend. So we'll say we'll write DOT, break of trend, just to summarize it. And then there's EOS, which is break of structure, which is when we're looking for a structure to get broken in the market, which will give more confidence to our movement. You see that. Then we have IPA, uh, which is impulsive price action, which is when we are getting basically an institutional movement. You see, so we call that, yeah, it's just impulsive. It's just impulsive. Yeah, and then from there, will be it's CHCOCH, which is change of character, which is when basically the market changes its character of how it's going. If it's changing, um, if it's going on an uprise, we'll start to see like some liquidity pools being created and boundaries. So that is usually what we call like our change of character. Right.
Oh, wait, you said the impulse price action is?
IPA.
Yeah.
Yeah, IPA. Oh, what it is. I'm sorry, man. So
Yeah.
what it is basically like an impulsive move, impulsive action within the price that we are looking at. So if we start to get an aggressive pull, it's an IPA. So we usually enter on IPAs, which they are also institutional move. They're also institutionally based. So a lot of institutions use these impulsive price actions, because that's how you'll be able to get a lot of liquidity out of the market quick. See that? So as you can see, this is starting to sell here. So we'll just keep an eye out for it currently as well. Yeah, so yeah, that will be the change of character, you see, or that will be the impulsive price action, something that's just, so for example, let me give you an example of an impulsive price action. So this, for instance, here, you see this aggressive movement here.
Yeah.
Let's just zoom in. So this, yeah, this is what we would call an IPA, because it's impulsive, it's quick, impulsive, and it stops. You see that? So these are our trades basically, and this as well. These very quick movements. So is this as well, and this as well. So you must know that an IPA always has always, it needs to be filled up as well. So it's what create gaps within the market, and we are the gap creators. You see, we are the guys that create the huge gaps. We're not the guys that how can I say, we're not the type to like color the market or like fill up the gaps. We are the guys that
Yeah.
yeah, that create the gaps basically. So you will start to see such yeah,
So,
such movements.
so yeah, it gets that aggressive, but then it doesn't have to be that aggressive, right? The IPA.
Well, it kind of, it has to be that aggressive.
Okay.
That's
So
the,
not like
yeah.
this one that we're looking at right now.
Which one?
The one we're watching right now for the entry.
Oh yeah, okay, you mean this one? Yeah, this one, it can be aggressive, or it can just move subtly as well. But what we're sure is that there's gonna be a movement. You see, so usually like those very aggressive ones is usually fundamental. So fundamental, which means that it pays attention to news. You know what I'm saying? So those are movements created by fundamentals. Usually, it doesn't mean that technicals can't as well. Technicals can, but in most instances, it has to be fundamentals. So as you know, the difference between technical and fundamentals, that technical is just technique, you know, has nothing to do with no, it's just technique, it's textbook, it's theory, you know, it's idealized. That's what technical analysis and technical trading means. Means you're trading order blocks, you know, you're trading trend lines, you know, yeah, you're trading stuff like that. So when we're talking about uh, fundamental, it means that we're trading things like the news, you know, what we're trading things like what's going on in the world. You're trading the companies, like revenues, like the revenues of the companies and stuff. You know what I'm saying? So that's the main difference. So us here, we use both. You know, we usually use a lot of technical, or we take advantage of some fundamentals when news are released and stuff.
Do you have news on both, or is it just?
News on both. What?
Do you get news on both the technicals and the I was gonna say, do you also include commodities in the technicals, or is it just companies?
Yeah. There's technical and fundamental on those. The only thing that's mostly strictly technical will be your synthetics, because they don't follow any news, or well, they do follow a bit of outside influence, like what's going on in the actual market, but in most
Yeah,
instances they go based on the on technique, on pure technique, you see. And then when it comes to the forex, they deal on technique as well as fundamentals.
all right.
Yeah. Yeah, so it's always good to have both in your back pocket.
All right,
So
away.
yeah,
Yeah,
these as well. There's something which is called pips as well. So a lot of people like to,
the
how can I say?
candlesticks.
No, pips is basically it's a measuring instrument. You know, it's a measuring instrument or a way for traders to measure point A to point B, like in simple terms.
Okay. Yeah.
In simple terms, just a measuring instrument or measuring median that traders love to use in order to measure point A to point B, you see. And then the difference between point A and point B is in between is your pips, your number of pips. You see that? So some call it
Oh,
points, some call it percentage, you know, it's, yeah, but the old guys like to call it pips, you know?
yeah.
Yeah, so that's just a measuring instrument. And then you'll have something called a swap, which is a daily fee. So when you're trading in Forex, some of these brokers, they charge you a swap. So swap will mean that you get charged for holding a trade overnight. See, so if you hold a trade for overnight, they charge you a fee, something like the bank, you know, for holding a trade overnight. So that is
Yeah.
what is basically called a swap. Then you have your spread, which
Is it only
is,
swap per night?
come again?
Oh, you said it's a daily fee, right?
Yeah, it's a
So it's
daily. If
gonna
you
go
hold,
each night.
if you have a trade that's going into the next day, they're gonna charge you what is called a swap, which is a daily fee, a daily holding fee. See that?
Okay.
Yeah. So yeah, they're gonna charge you, I don't know, maybe something like 2 rand or something. It just depends. And then the spread is basically the difference between the current price and the market price.
All right.
Market. So yeah, what you see basically sometimes is not what the price of that they're selling at. It can just be the price of that thing, it doesn't mean that is the price of which they are willing to sell it at you. So there's about 3 different prices at the end of the day. So you get your market price, your bid, or your buy price. You see. So, and then what the difference between what the actual market price is and what the price you're going to buy it at or sell it at, that difference is called the spread. You see, that's how the price is spreaded across. So most of these brokers make their money off the spread or the commission of how they decide to spread their price on something. See,
Oh,
yeah, okay. So then you have your spread, and then after you have your spread, there's gonna be what we call like indicators, and
so wait, does the spread come out of
instruments.
you cut for the day as well?
That's it.
Does the spread come from the profit you made on the day?
No, no, no. It doesn't come from the spread. They charge you as soon as you enter your the position. So that's why when you enter a position, you're going to go into negative. Like as soon as you enter a position, you can go into
Yeah.
negative. Yeah. So that negative between what your current account is basically that spread in simple terms. It's basically that spread that you are paying to them in order to buy that
Oh,
thing or
okay.
in
As
order
soon as
to,
okay, yeah, okay, that makes sense. Yeah.
yeah. Yeah. So yeah, it's like that as soon as you buy or sell that thing. Yeah, and then with
Yeah.
that low negative, that's where they make their little commission or so, or their little cash. See that? So and then we have indicators and instruments. So indicators and well, in this, when you're trading with the gold snipers, we will never teach you about instruments and indicators. The only indicator that you are using is the price. Is the price on your left or on your right, wherever this thing here. This is the
Yeah.
only indicator and it's the price. You see, so that's the only thing we use. Don't go using all these MMAs and these different RSIs and these whatevers. We don't teach that here. See,
Uh,
we teach pure analyzing, the smart money concept. That's what we teach here. And that does not rely on any instruments or on any indicators. You see, so if you start telling me about instruments and indicators, I'll know you're listening to someone else. See,
yeah.
so yeah, no indicators, no instruments. This that we don't use. Yeah, so I think this is majority of the jargon which you're gonna be needing to use um into the market, and like when you get into conversations with people, even me, or the other mentees on the group, this is basically the jargon that we use. So as I said as well, was it ICT? Remember, it's into side, cycle trading, and then we have SMC, which is smart money concept. So these are the two that we are trading. So I've only dived into ICT with you, which is the current system that we've been going through. So now we're going to be looking to dive into the SMC, which will broaden
Oh,
your perspective, yeah, into technical analyzing. See that?
yeah.
So, bro, man, I think we have about a minute left. So I don't know. Do you want to ask any more questions? Some things we can go through.
I think no, I think yeah, this works for now. I think we can definitely start up a different session for the smart money concept. So yeah, I'm good, bro. I also know that I need to put just more practice and shit. So yeah.
Okay. Okay. Now that's lovely. Yeah, just also, yeah, go over these concepts, keep back testing
Yeah,
that.
that's what I was. Yeah, I wanted to look at more jargon. Yeah, just
Okay.
to research more jargon in general.
Yeah. Okay, very good. But yeah, but the ICT, man, just keep back testing it, bro. Like I said, like the more you keep back testing these things, go to like a year, go to last year, go to last month, go to 2 months ago, go to 2 years ago, and just maybe even for the whole week, oh, like for 1 week, just go through how this ICT works. You start to see how they compound, and how they do everything.
Oh wait, no, I will definitely do that, bro. Practice makes perfect.
As always, as always.
Yeah.
Okay, we'll be sending you the video soon.
Oh wait, thanks, G.
Okay, now, no problem. Until our next meeting, bro.